So Neogen Chemicals reported a good set of first quarter numbers. The revenues were up 9%. According to the company, the revenue growth was led by volume growth. Harin Kanani, the managing director at Neogen Chemicals, joins us now to discuss their Q1 performance and the outlook for FY25. Harin, thanks a lot for joining and appreciate your time here. Good numbers coming through for the company. But I just wanted to start by asking you about pricing because, you had mentioned last time around that pricing continues to be under pressure. Is there any possibility of it improving from here on? How is the situation on the ground right now? And what's the expectation for FY25?
I think on the pricing, we have basically seen that the lowest price of our raw material, lithium and bromine, we have seen. And also, from our competition in China, they've been very aggressive last 1.5 years. But most of the places we have seen the lowest prices. And then now maybe the prices are slightly remaining stable or recovering. Overall, as a market, what we have seen is we've seen a very good response and interest in our BuLi chemicals related organolithium molecules. So those are doing very well. We have started some revenue contribution coming even from our battery material business. We have seen pharma almost stabilize and improve, except for the pricing part. There's a good volume growth we are seeing there. We are seeing also volume growth in our inorganic lithium. Agro still remains a bit of a concern, and there are still other initiatives which we have taken, advanced intermediates in pharma and our CSM business in other industries, which including some semiconductor related projects, which we hope will basically allow us to make up for in case agro doesn't recover fully or we still see headwinds in the agro sector.
Okay. You said the battery material business also contributed in the current quarter. How much did it contribute? And, if you could give us, say, the exit contribution of battery materials by FY25 end.
So, the battery sales were mostly related to only trial sales for all the three segments. So some basic lithium salts, as well as advanced lithium salts, electrolyte salt, as well as trial sales of our electrolyte. So it was basically trial sales in single digit in crore terms. So not a very large from contribution point of view, but we are happy. This is the first quarter when the plant, even though it's not yet fully capitalized and not fully operational, but still we were able to get this kind of revenue from the part capacities which have come online. So that's a positive start on the battery. Overall, we have estimated this year it will contribute somewhere around 75 to 100 crore. But next year, when this capacity will be fully utilized, we see a revenue of at least 250 crores. On top of that, additional capacities, brownfield expansion, which we are undertaking this year, as they get approved, they will contribute. And also our greenfield site, which is almost 10 times bigger, that also is coming online in next financial year. So next financial year, we'll see full contribution from the existing capacities, new brownfield capacities, as well as the greenfield. So it will be 250 crore plus the contribution of the new capacities which are coming online. Together, these capacities on full utilization can contribute almost 2,500 crores. So we'll keep a watch, how much we can do next year. But FY27 is when we'll have all the capacities available for the full year.
Okay, so when these capacities come on stream and, when it contributes to your revenues, I'm sure there's some amount of debt that you would be taking up as well, because I understand that you're expecting a debt of 1,500 crores over the next 3 years. Will that be the peak debt, or do you think that it could get higher than that?
So I think 1,500 crores is the total capex which we are doing, of which the debt component would be around 1,100, 1,200 crore. Including our working capital in the main business and some capex. 1,500 crore would be like the peak debt is what we are today seeing. I think we also kept an option to raise more equity if needed in the future. It can be in the form of either a strategic in our battery business or just raising more equity in Neogen if needed. So we'll keep a watch on the debt equity ratio depending on how well the battery business develops and depending on the business needs. But that seems to be the peak that we are expecting, at least based on projections which we've seen now.
What will margins look like? Because on one hand, pricing is going to remain subdued. It may not recover even through the course of this year, but you are seeing increasing contribution from the battery business. So what would consolidated margins look like for you in FY25, FY26?
So on a full utilization basis, let me go back. Our base business of pharma agro, at least FY25, FY26, once the margins recover, we can be somewhere around 18% to 20% range once markets recover a bit. And the battery business, we have given EBITDA margins of around, basically it's ROC driven. So we are targeting a 20% ROC kind of margins there. But on the EBITDA basis, depending on price of lithium, it can be somewhere around 16, 17% on EBITDA. So that's basically the margin. So let's say on a full utilization basis, Neogen Chemicals, traditional business, including organolithium, can deliver on a good year 18, 20% kind of margins. Let's say on the lower side, around 16 to 18%, what we are seeing the trend in last 1 year. And the battery business, ROC basis around 20% plus. But on margins, maybe around 16% EBITDA is what we are expecting.
But that's on full utilization. So this year, you're not going to have full utilization. The revenue contribution is only going to be 7,500 crores. And even the base business is not going to go back to the optimum pricing. What can we expect for margins this year?
I think this year, again, the capacity is also not coming fully. So as we don't have full utilization, we don't also have all the full expenses also. So we are still targeting, let's say, 16 to 18%, 19% kind of, between 16 to 19% kind of a broader range, because this business is just starting up. It's a bit more difficult to predict, more accurate. Otherwise, normally I like to give plus or minus 1% range. But because of the uncertainty, I would like to basically maintain a 16 to 19% kind of EBITDA range for the current year.
Okay, we'll leave it at that. Thanks a lot for joining in and all the best for the quarters to come. Let's take a short break on that note. On the other side, we'll discuss the market fundamentals. Ashi Anand of IME Capital will be joining in. Stay tuned.